Fixed, variable, adjustable, open, closed, payout penalties, prepayment privileges, mortgage, HELOC, multiple components, posted rates, discount rates, banks, credit unions, trust companies, insured high ratio, insurable, conventional, the list goes on. So these are just some of the terms of a mortgage, of multiple different types of mortgages that we deal with every day, day in and day out. Understanding, knowing what all of these things are, that's what my job is so that I can provide guidance to you guys. So, um, I love that tonight's about finding the perfect property. We wanted to talk about finding the perfect mortgage, which is just as important. And when I say perfect mortgage, I don't mean lowest rate. So oftentimes, as an investor, we need to switch our caps and we need to think like an investor and not like a lowest rate possible, pay my mortgage down as fast as possible homeowner. So rate matters, of course it does, but the mortgage setup, the structure, the flexibility, the terms can have a far greater impact on your final outcome than a fraction of a percent on an interest rate. So the truth is, the perfect mortgage actually depends on your strategy. So to give you an idea, if you're buying a property to flip, you do not want to be locked into a closed mortgage with high penalties. You want an open product designed specifically for short-term holds. Why? Because penalties and CMHC fees will cut directly into your profit. If you're in and out of a property in 6 months, let's say, the wrong mortgage could wipe out a significant portion of your return. A slightly higher rate on an open product can actually save you thousands because there's no penalties. Now, let's say you're selling your home and your mortgage is actually coming up for renewal. This is happening a lot lately. We're going to see quite a few properties get offloaded this year. Lots of people are coming up for renewal. It's the largest renewal year in history in Canada. So flexibility becomes critical. In a situation like this, we're looking again at an open mortgage or like a closed variable where there's only a 3 months interest penalty, because the last thing you want to do is renew into a 5-year fixed, go to sell your home, accept an offer, the payout penalty comes in at closing and it's a 5-figure penalty. So the right structure gives you the freedom to move and sell when the market's right for you. If we're refinancing, the goal is usually different. We're often trying to improve cash flow on properties, or we're trying to help qualify to buy additional properties. So in that case, extending the amortization to 30 years can make a really, really big difference. Yes, the rate might be a bit higher, but the payment is going to be lower. So that's going to mean for better cash flow and way better qualifying when we try and buy more properties. So again, the strategy is driving the structure that we're putting together. If you're purchasing a long-term hold, that might be different. Your forever home or a buy and hold, that's where we can explore, 5-year fix, 3-year fix, maybe stability and predictability may be more important than flexibility. So in this scenario, locking in might provide peace of mind and mindset for a homeowner, payments over time, long-term hold. And then, the BRRRR strategy. This is something we like to talk about. Buy, renovate, rent, refinance, repeat. Mortgage structure is critical for this. We want to work with lenders that allow multiple component mortgages. So this way, when you're refinancing, instead of having to pay out the entire mortgage and incur penalties, we can add on multiple components once the renovations are complete. So we can constantly access equity as our value and our mortgage paydown continues to grow. Then there's things like home equity lines of credit. They're great in theory, everybody wants one, but when we kind of drill down and see, okay, what are your goals? What are your plans? How quickly are you going to pay this mortgage off? Are you going to pay an extra percent or percent and a half interest only payments on something that you're going to not be able to pay off for 3 or 4 years? Or should we put that in the mortgage? And something else to consider is how lenders calculate what you owe on a HELOC. Very, very different than a mortgage. Oftentimes, having a HELOC can really impede our ability to qualify for additional properties. So these are all things that when I'm taking a mortgage application and we're looking at your existing properties or we're coming up with a plan for more, we're taking all of this into consideration to make sure that your mortgage is set up properly to be as advantageous as possible to accumulate properties, avoid fees, avoid penalties. So when we're thinking about the perfect property, we also want to think about the perfect mortgage strategy. You need to ask yourself, how long am I going to own this? Will I need flexibility? Am I doing any improvements? Will I sell relatively quickly? Am I doing a flip? Is this a long-term hold? Am I building long-term wealth? Because the mortgage isn't just about today's rate, it's about aligning the financing with your long-term plan. A great property can build wealth, but the right mortgage structure protects it. So it's really, really important when you're looking at your mortgage that you're not treating it like it's just a rate and just a payment. And that's what I've got for you today.
Hey, thanks, Danielle.
Good
Yeah,
stuff,
you're
Daniel.
welcome.
There is a question in the chat there. I don't know if
Yeah.
you got your chat up.
What is the minimum amount of investment cash? So it really depends. We talk a lot about the move up program here at Crew. So buying a property, moving into it, turning around, turning it into a rental, then buying another one, living in that for a while, turning around, doing it again and again. So if we are buying an owner occupied, then we would be buying with, minimum 5% down payment. If we're buying a rental as a rental, then we need a 20% down payment. So, it just depends on the strategy. There's second home strategies where the minimum is 5% as well.
Awesome. And what people have to understand out there, we get this all of the time. Why we've worked with Danielle for nearly 20 years now, is simply because she looks at the big picture. So she doesn't just get you a mortgage. We always say this. She puts together a mortgage plan, meaning we know how to get property one, property two, property three, property four, and property five. So you have to work with professionals that understand that and understand what cash flow is coming from the first property, and then how do we get into the second one? And then, as Danielle was saying, she mentioned the move up program. It is the best way to get ahead by putting 5% down, moving into a property, and then eventually moving out and making that a rental property. And there's a lot that goes into the mortgage side on that side of things, and then also on the real estate side of things, because you need to make sure that the rents will cover your costs. So then Danielle can move you into property number two. And then sometimes we look at suited properties because Danielle can use both sets of rents to allocate towards your income. So then you can purchase more. So you have to understand that there's a whole system when you do work with Calgary Real Estate Wealth and professionals like Danielle. There's a whole system behind it. And sometimes I'm not even worried about the interest rate too much. I know you could probably sometimes get a better deal out there, but if that means I can buy multiple properties, that's the least thing I'm worried about.
Yeah, and there's another question about getting a discount on the transaction. Calgary Real Estate Wealth, us realtors here, we're in the market every single day, and we negotiate as hard as anybody out there to get our investors the best deal. And any of the investors on this call that have worked with us can tell you that right now. If you need a realtor to get an investment property, you're looking at them right here. And we don't make any excuses for that. We just know we're the best out there.
Yeah, and then the other thing about buying real estate and using Danielle's services, it's free. Like it's basically free. I mean, Danielle, what expenses are there for first-time home buyers if they're doing an appraisal, or is there any expenses on your end? Because there's nothing on our end except a home inspection, and then that's basically it.
Maybe a condo doc review.
Our condo doc
Yeah.
Yeah,
review,
but that's kind of it. Yeah, no, I'm cheap and cheerful. I'm free. Smiley face.
yeah.
No, yeah, you don't pay for my services. The lender compensates us. That's how we get paid. As far as costs go, if an appraisal's needed, that's a pretty standard possible expense. And then obviously legal fees. You need to use a lawyer when you're buying, selling, or refinancing because it's a legal transaction. So and I can speak to when you're looking at discount brokers, it's or real estate agents or rates or whatever it is, discounts. You get what you get what you
Yeah.
pay for.
Yeah.
Like a wrong investment property is, I mean, I've had clients who need to offload properties because they bought the total wrong property and they put themselves in the total wrong mortgage. It's not cash flowing. It can't survive when the rents soften a little bit and they're negative cash flowing and they're offloading these properties and paying selling realtor fees when they just bought it a year ago. So you get what you pay for. You got to use proper professionals. It's part of being an investor. So,
Cool. Hey, thank you, Daniel. That was a
oh, you're
great
welcome.
Yeah, thanks,
session.
Danielle.
Yeah.
Yeah,
So
you're
that's
welcome.
Danielle's market update. Her contact info is on the bottom of this page right here. If you need to talk to her about your mortgage, refinance, a line of credit, anything like that, just take her contact info down. She's definitely number one in the business for that.